Did you know that right now, a company posting record-breaking, multi-billion-dollar revenues just watched its stock collapse nearly 39% this year? A company that just crushed every single earnings estimate on Wall Street, added over 1 million new customers in a single quarter, and confidently raised its guidance for the entire year. And yet, the market treated it like a failing business. Welcome to the ultimate valuation disconnect. Today we are pulling back the curtain on SoFi Technologies, and I am going to show you exactly why these earnings are genuinely incredible, and the one thing the market appears to be completely missing right now. Because here is the truth. While the headlines scream fear, the numbers underneath tell a completely different story. We are going to isolate exactly what is happening under the hood, evaluate the explosive Q2 2026 earnings, and find a highly specific, actionable long trade setup. We are going to capitalize on the massive divergence between a company's underlying fundamental growth and the emotional, panic-driven market sentiment. And these growth numbers look absolutely incredible, but there is one hidden metric we will look at in just a moment that changes everything. Before we go any further, if you enjoy deep dives like this one, do me a quick favor and hit that like button and subscribe to the channel. It genuinely helps me bring you more of these breakdowns. To understand how we actually make money on a setup like this, we first have to understand the massive gap between the business and the stock price. So look at the stark contrast we are dealing with here. On one side, you have the business reality. The company is scaling flawlessly, hitting record revenues, accelerating user acquisition at a breathtaking pace, and management just confidently raised their full-year guidance. Everything about the actual business is firing on all cylinders. But on the other side, you have the market reality. The stock has suffered a severe price disconnect, plunging roughly 37 to 39% year to date, and is currently trading down in the high $15 range, despite absolutely crushing earnings. Now stop and ask yourself, how often do you actually see a company grow revenue at over 40% while its stock gets cut by nearly 40%? This massive Q2 gap down is not a reason to panic. It has actually created a rare, low-risk entry window for the smart investors who know where to look. If we dig deeper into the actual numbers, you will see exactly why this sell-off makes zero logical sense. Just look at this Q2 fundamentals dashboard. SoFi did not just beat estimates, they obliterated them. GAAP net revenue came in at a staggering $1.218 billion. That is a massive 43% increase year over year. And profitability. They logged a record net income of $156.6 million, delivering earnings per share of 12 cents and beating the Wall Street consensus. The ecosystem is exploding, adding 1.1 million new members to reach a total of 15.8 million, while originating a record $14.8 billion in loans. And management is so confident in what is coming next that they raised their forward outlook for the full year to a massive $4.75 billion to $4.85 billion. So let me ask you this. Does that sound like a company whose stock deserves to be down nearly 40%? It simply does not add up. Now, none of this matters if we do not honestly look at the risks, because Wall Street certainly is. So why did the stock dip 5% pre-market down to $15.75 after a blowout quarter? We have to diagnose the bear case. Wall Street is hyperfixated on three specific things. First, tech platform weakness. Revenue there dropped roughly 23 to 27% due to the planned exit of a major client, dropping enabled accounts by 16%. Second is the H2 margin challenge. To hit that massive raise guidance, SoFi needs to achieve a steep 37.7 to 38% adjusted EBITDA margin in the second half of the year. That is roughly $463 million per quarter. And finally, we have the muddy waters effect. A vocal short seller doubled down on claims of, quote, Enron-esque fair value loan accounting. Now, SoFi vehemently denies this and strictly maintains full JAP compliance, but the headline fear remains, and fear, as we know, moves stock prices in the short term. But that is only half the story, because SoFi possesses a secret weapon that almost completely neutralizes these risks. That secret weapon is their structural moat, the bank charter. This is the single thing that separates SoFi from every other vulnerable fintech on the market today. Thanks to their charter, SoFi has built a massive $45.5 billion deposit base. This creates a closed deposit funding loop where they can fund over 90% of their own loans internally. And this one mechanism saves them a jaw-dropping $600 million in annual interest expenses. Just compare that to non-bank fintechs like Upstart, which rely heavily on external capital markets, constantly eroding their margins every time interest rates move against them. SoFi is insulated. So here is a question worth sitting with. What happens to a company this protected when the market finally realizes it has been mispriced this entire time? And here is the thing. The biggest players on Wall Street have already figured this out. Follow the smart money flow. Right now, institutions own 38.43% of the total float, and they are using this retail panic to aggressively build massive long-term positions. Look at these tier 1 funds scooping up shares. UBS alone added an incredible 21 million shares, representing a 136% increase to their position. Cube Research added 13.3 million shares, and Goldman Sachs bought up another 8 million shares. When the big money is buying the blood in the streets while retail investors are panic selling, you need to pay very close attention. These are not emotional decisions. These are calculated, deeply researched bets on where this stock is heading. But it is not just the institutions putting their money on the line. The people actually running the company are doing it too. Insider conviction is screaming a massive buy signal here. CEO Anthony Noto just put roughly $250,000 of his own personal cash on the table, buying 15,504 shares right at the $16 level. Now, you might see some headlines about EVPs or CTOs, but do not let that fool you. Those were routine, pre-arranged 10b5-1 tax sales. They have nothing to do with conviction. Meanwhile, the company is aggressively expanding its ecosystem in every direction. They launched an AI-powered platform called Composer by SoFi. They are acquiring the UK retail investing platform PrimaryBid, and they just secured a landmark multi-year financial services partnership with Notre Dame Athletics. Ask yourself this: why would a CEO put $250,000 of his own money into a company he thought was in trouble? So, what is all of this actually worth when we strip away the emotion and look at the raw math? Let us do a valuation reality check. The market is currently pricing SoFi as if it is a slow-moving, mature value stock trading at a forward price-to-earnings ratio of roughly 28. But now look at the growth trajectory. They are projected to grow earnings at a massive 38 to 42% compound annual rate all the way through 2028. Because of this, the key metric we really need to focus on is the PEG ratio, which currently sits at an absurdly low 0.81. And in finance, a PEG ratio below 1.0 flags a deeply discounted asset relative to its proven earnings growth. Let that sink in. They are a hyper-growth fintech being priced by the market like a failing regional bank. How long do you really think that kind of mispricing can possibly last? However, to time our entry perfectly, we need to understand the technical gravitational pull that is currently holding the stock down. Looking at the technical landscape, the price is currently trapped underneath heavy moving average resistance following a Q1 death cross. The stock is fighting a 20-day simple moving average at $17.77, a 50-day SMA clustering between $17.15 and $17.24, and the massive 200-day SMA sitting way up between $18.68 and $21.54. Right now, the stock is buried underneath every single one of them. It requires a massive fundamental catalyst, like the complete digestion of this recent earnings blowout, to finally break the gravitational pull of that 50-day line. And could this earnings report be exactly the catalyst that snaps it loose? That is precisely what we are positioning for. But if we look at the momentum indicators, the selling pressure is actually exhausted. Our momentum oscillators tell a fascinating story here. The 14-day RSI is currently sitting completely neutral between 44.09 and 48.27. It has a slight bearish bias, but it is nowhere near severely oversold. Meanwhile, the MACD is flashing a standard sell signal, reflecting that recent pre-market gap down. But the synthesis here is absolutely crucial. Momentum is muted. The complete lack of extreme oversold conditions actually suggest that this drop to $15.75 is calculated institutional repositioning, not widespread retail panic selling. The big money is not fleeing. They are simply shifting their weight, quietly getting into position before the rest of the market catches on. And despite all this technical weakness, the analysts still see a massive runway ahead. When we map out the analyst sentiment, you will immediately notice a bizarre contradiction. The official consensus rating remains a cautious hold. But look at the actual math behind that rating. With the current price hovering near $15.75, the average 12-month price target cluster is entirely isolated between $20.58 and $22.83. And the high-end estimates from firms like Citigroup place the peak at a full $30. So think about what that really means. Despite those cautious hold ratings, the underlying math implies a massive 25 to 35% upside from current levels just to reach average fair value. When the ratings say hold but the price targets scream buy, which one do you think is telling the real story? But to predict where the stock actually goes next week, we have to follow the options money. Welcome to the options market architecture for the July 31st expiry. The market is pricing in a volatile 10.45% post-earnings implied move. Now think of this like a castle with a heavy ceiling and a reinforced floor. The ceiling is built on massive call open interest, establishing an almost impenetrable resistance wall at the $18.50 strike, with over 117,000 contracts, and again at the $23 strike, with 107,000 contracts. Conversely, the floor is established by heavy put open interest, building rock-solid technical support at the $16 and $15 strikes. Market makers will fight tooth and nail to keep the price trapped right between these two walls, and knowing exactly where those walls are is what gives us our edge. And trapped within those very walls is a massive amount of extremely nervous short sellers. Let us talk about the fuel for a potential rally, the short interest. Right now, a staggering 185.9 million shares are sold short, representing almost 15% of the total float. That is an enormous amount of fuel sitting there waiting, but we do have to look at the nuance carefully. The days to cover ratio is a very low 2.3 days. That high daily liquidity means that while there is ample fuel for sudden upward momentum if shorts are forced to cover during a post-earnings relief rally, a prolonged so-called mother of all short squeezes is mathematically unlikely. They can escape a little too quickly. Still, imagine even a fraction of those 185 million shares scrambling for the exit at the same time. What do you think that does to the price? So how do you actually play all of this? Well, it all depends entirely on your timeline. Your strategy depends completely on the divergence of your time horizon. In the short-term trader matrix, you must closely monitor the net charge-off rates, which are currently climbing to 3.03% for personal loans, along with the H2 EBITDA margin progression. If those charge-offs stabilize, this stock violently snaps right back to the 50-day moving average. But in the long-term investor matrix, all you really need to monitor is the bank charter and the deposit base. That $45 billion deposit base fundamentally insulates SoFi from capital market shocks, permanently separating it from every struggling non-bank fintech peer out there. Two completely different games played on two completely different clocks, which brings us to the ultimate payoff, the specific, actionable trade setup for this week. Here is your actionable trade setup for the week of July 29th to August 4th. Our trade logic here is anticipating a post-earnings relief bounce as the market slowly digests the raised guidance and that algorithm-driven gap down. Your entry zone is exactly between $15.50 and $16. This perfectly aligns with the pre-market drop and the massive options put open interest floor we just looked at. You place a hard stop loss at $14.90, just below the 52-week low. If it breaks that level on volume, the short-term thesis is temporarily invalidated by macro fear. For your targets, take profit 1 is at $17.15 to $17.20, playing the convergence of the 50-day moving average, and take profit 2 is $18.50. Which is that absolute short-term ceiling defined by the 117,000 call contract wall. This gives us an exceptional risk-to-reward ratio, leveraging an irrational earnings gap down directly against those structural market maker flaws. Now, before we wrap this up, I need to be completely clear with you. Everything I have shared in this video today is for educational and informational purposes only. I am not a licensed financial advisor, and this is absolutely not financial advice. The stock market carries real risk and you can lose money. Every number, Every price target and every setup discussed here is my own analysis and opinion, not a recommendation to buy or sell anything. Please always do your own thorough research and consider speaking with a qualified financial professional before making any investment decision. Your money is your responsibility. So here is the big question I want you to think about, and I genuinely want your answer down in the comments. Do you believe SoFi's bank charter and that $45 billion deposit base make it fundamentally uncrushable, or do you think the market is right to stay cautious? Drop your take below. I read every single comment and the best discussions happen right there. If this breakdown gave you a clearer picture of what is really going on with SoFi, smash that like button. And if you are not subscribed yet, hit subscribe and turn on notifications so you never miss the next deep dive. This has been Calvin Mateo. Trade smart, manage your risk, and I will see you in the next one.